When people hear the words market crash, they picture fear, panic, and financial ruin. They imagine traders losing everything, families facing foreclosure, and retirement slipping away. But here's the part history books never highlight. Every major crash in American history has been followed by the biggest wealth transfer of that era. And the people who understood the pattern didn't just survive, they got richer than they ever imagined. The evidence is everywhere. After the crash of 1929, the investors who bought during the worst moments earned returns that today's tech billionaires would envy. When the dot-com bubble burst in 2000, patient buyers who focused on real value watched their portfolios grow 10, 20, even 50 times over the next 2 decades. And when the housing market collapsed in 2008, it quietly marked the beginning of the longest bull run in modern American history. Now we're standing near that same cliff again. Every meaningful economic indicator is flashing red, and if history repeats, the event expected around 2026 won't be a simple correction. It will be a full reset of the system. The question isn't whether you'll survive it. The question is whether you're preparing to profit from it. Because here's the truth most people never hear. Crashes don't destroy wealth. They move it. They move it from emotional investors to rational ones. From the unprepared to the prepared. From panic sellers to strategic buyers. To understand what's coming, you need to understand the cycle America has repeated for over a century. Every 18 to 20 years, debt, speculation, and artificial growth collide with reality. It happened in 1929, the 1970s stagflation, the dot-com collapse, the 2008 crisis, and now based on every major metric, it's building again. The CAPE ratio is near its second highest point ever recorded. Consumer debt is at levels that would have been unimaginable a generation ago. Corporate America is loaded with cheap debt that becomes dangerous when rates rise. Government spending is so extreme that even the Federal Reserve has started warning about sustainability. Meanwhile, the experts who missed every major crash tell you not to worry. They said the same thing in 1999. They said it in 2007. They were wrong both times. But the smart money isn't ignoring the signs. Warren Buffett's company is holding more than $300 billion in cash. Hedge funds are building defensive positions. Institutions are moving out of overvalued growth stocks and into safe haven assets. Unemployment forecasts are rising. Consumer confidence is slipping. Credit card delinquencies are climbing. Commercial real estate is weakening. These aren't random numbers. They're early warning signals. But the wealthy never see crisis the way most people do. When others see danger, they see opportunity. They know crashes transfer assets from weak hands to strong ones, from borrowers to savers, from short-term thinkers to long-term strategists. Think back to 2008. Millions lost homes, jobs, and savings. But a small group of investors made generational fortunes. They bought real estate for 30 cents on the dollar. They accumulated world-class companies at prices not seen in decades. Amazon fell from over $100 to $6. Netflix traded for less than a monthly subscription. Apple, Google, and the companies that now define the modern world were available at bargain prices. This pattern repeats in every historic downturn. During the Great Depression, Rockefeller famously said fortunes are made when blood is in the streets. While the world panicked, those with capital bought railroads, oil companies, and manufacturing giants for almost nothing. And the reason is simple. Crashes follow predictable psychological and mathematical cycles. Easier money creates more speculation. More speculation creates bubbles. And every bubble eventually bursts. Today we're living through the largest debt expansion in human history. Governments, corporations, and consumers are borrowing at levels that break every previous record. Asset prices have been inflated by a decade of artificially low interest rates. Many homes are priced beyond the reach of an entire generation. Stocks have separated from real earnings. Bond markets depend on the assumption that governments can always pay, but math always catches up. Rates are rising. Inflation remains stubborn. Debt costs are climbing. Corporate earnings are slowing. Consumer spending is cracking. It's the same setup that has preceded every major downturn. But here's the opportunity almost everyone will miss. When the crash hits, it won't erase real value. It will expose which assets were real and which were illusions. Quality companies will survive and grow. Prime real estate will remain useful. Precious metals will protect purchasing power. The winners will be the people who prepared ahead of time, not the ones who react too late. And preparation starts with rethinking your entire financial strategy. Most people behave like consumers. They buy when prices are high and sell when prices collapse. The wealthy do the opposite. They build cash when everyone else celebrates gains. They buy when fear dominates the headlines. Cash becomes powerful during a crash, not because it's safe, but because it gives you the ability to buy what others are forced to sell. But holding cash alone isn't enough. You must know which assets truly hold long-term value. History shows that companies with strong earnings, low debt, and essential services come out of crashes stronger. Real estate in good locations remains valuable long after temporary drops. Precious metals protect against currency declines. And dollar cost averaging becomes a powerful tool when used correctly, buying more as prices fall and less as prices rise. but you'll face intense psychological pressure. During the build-up, the media will promote endless optimism. During the crash, they'll predict the end of capitalism. Your friends will chase gains at the top and panic at the bottom. Discipline is what separates those who profit from those who freeze. Diversification changes too. It's no longer about spreading risk. It's about spreading opportunity. Some assets protect you during the fall. Others multiply your wealth during the recovery. Debt becomes the biggest threat because it forces liquidation at the worst moment. The people with no debt can buy while others are forced to sell. And the businesses that thrive in downturns usually share traits you can identify early: strong cash, low leverage, and essential products. Government responses matter too. In every crisis, they choose inflation over deflation. It protects borrowers and punishes savers. That means cash loses purchasing power, but real assets gain value. Central banks will print money to avoid collapse, but printing has limits. And we are getting close to those limits now. The global financial structure is shifting. The Federal Reserve's balance sheet has exploded from under $1 trillion to over $8 trillion. Europe used negative interest rates. Japan prints money at levels no previous generation would consider normal. These are not temporary measures. They are evidence of a system that cannot survive without artificial support. When debt grows faster than the economy's ability to pay, something must break. Either the currency weakens through inflation or the debt collapses through defaults. Both create wealth transfers. One is slow, one is sudden. Together, they are unavoidable. Smart money knows this. They borrow while rates are low to buy real assets that rise with inflation. They avoid fixed income investments that get wiped out. They save cash during the inflation phase so they can buy distressed assets during the default phase. And they diversify globally because crises never hit every country at once. The Asian financial crisis of 1997 destroyed several economies while opening doors elsewhere. The same pattern will repeat. The only question that matters now is simple. Will you be on the right side of the next wealth transfer? If you want to stay informed, stay prepared, and stay ahead of this cycle, make sure you're part of the Financial Saving Secrets community. Subscribe now, turn on notifications, and let's build your financial advantage before the next reset begins.